Of all the weekly dividend ETFs, the highest dividends and overall best returns come from the weekly paid dividend ETFs by RoundHill. And we have some massive news today. They are adding more. They're already out, actually, and I cannot believe this. I will be shifting more money into the account to track these as well, and I'm very excited for some of the huge names that you are not going to want to miss out on. Now, if you guys don't know, I follow all things ETF investing, and if you're interested in making money in the market and making passive income, you are in the right place. So don't forget to like the video and to subscribe so you never miss an update on the free stuff and crazy news coming out about these weekly dividend ETFs. Let's roll that intro. Here is the full list of the new and old weekly pay ETFs. The new ones we are looking at: ticker AMZW is on Amazon, ticker BRKW is on Berkshire Hathaway, then we have ticker HOOW, which is on Robinhood, we have METW on Meta, and we have NFLW on Netflix. So if you don't know how these work, I'm going to do a little breakdown, a little recap on how the leveraged funds work. And I'm really interested in seeing your opinion on these stocks selected. Some of them I'm a little surprised about. I mean, BRKW is interesting. I don't dislike it, but it is interesting. And then, of course, Robinhood has been a very, very crazy stock to watch as well. There are some other stocks I would have picked, primarily maybe MSTR, maybe SoFi, maybe Reddit, a few more that are higher volatility, I guess you would say, maybe a little higher risk, but we will see how these dividend payments do. And I'm really interested in tracking these over time and finding which one does the best. Of course, a lot of that's going to depend on the underlying stocks. So if you're interested in weekly passive income from just holding some of the stocks you believe in the most, Amazon, for me, is one of the biggest. These are for you. But let's get into what make these funds work. There are some risks with these weekly pay ETFs that I will touch on in just a moment. We're going to look at the fact sheet of AAPW. But I want to say the key points that RoundHill is pushing with these, of course, are the weekly distributions, which are becoming so popular. If you guys are new to my channel, there are so many videos and series on these weekly dividend ETFs. It's kind of my bread and butter, along with some of the YieldMax funds. And I will say I love the weekly payments. I really do. And they've done way better than I anticipated when they first started coming out. Now, mind you, there were 8 initially, and now we have about 30. So big news. They also want to focus on the enhanced exposure, which you're going to amplify your returns by targeting a 120% of the reference stock's weekly performance. Meaning, if Tesla goes up 1%, you are going up 1.2% with the performance of the ETF. That's the goal anyway. That's what they're targeting. And of course, you're getting that income. And I like that because a lot of these stocks I think will do well over time, and a little bit of leverage playing in is phenomenal in my opinion. Not financial advice, that's how I like to invest. A 2x or a 3x can be too scary for a lot of people, myself included, on some of these funds that move all over the place, or the underlying stocks that move all over the place. But a 1.2 is still relatively conservative, but you're tossing in a little bit of risk there. And that's one of the main focuses, of course. The last one being that you have single stock leverage and weekly income. And that was what was really new with these. Now, there are still some. We're going to talk about swaps in just a minute and get into the details of the risks with these funds, because there are some, including what happens if the underlying stock absolutely tanks. At what point do you lose all of your money? We're going to look at that in just one moment. But check these out. Let me know which one is your favorite new one in the comment, because I'm curious what everyone's going to be buying first. Of course, I will be buying them all to showcase their returns for you guys and update you every single week. I will say that AAPW has been one of the worst performers simply because of Apple's stock performance since the beginning of 2025. It's just rough. There's nothing else to really say about it. Also, the expense ratio on these is 0.99%, which is quite high. Not as high as some of the other weekly payers, but important to know. And the AUMs have all shifted. They're still relatively low, which is assets under management, meaning the amount of money in these funds. But I mean, they're lower, a little bit higher risk, but some of them have already gone up to the 10 plus million assets under management. Now, when we scroll down, there's a lot of details on here, and I recommend you guys check them out for yourself. But I will say, they say right here, distributions in excess of the fund's current and accumulated earnings and profits will be treated as return of capital, which is really interesting. If you're not familiar with return of capital, it's basically a tax. It's a beneficial way of getting paid where your taxes are going to be less. So in that case, a return of capital distribution generally will not be taxable, but will reduce the shareholders' cost basis. And it gets into a whole bunch of details, which I do like and I recommend checking out, but I'm not going to go too far into it. They also then talk about the leverage risks and then the swap agreements risks, which is a big factor. So utilizing swap agreements to derive its exposure to the shares of the security indicated by the fund's name. I will also say they do not hold the underlying. They do not hold the underlying stock. So you are not directly investing in Amazon, in Meta, in Robinhood when you purchase these. And that covers one of the things that they say is critical for investors to understand. The second is that each fund strategy is subject to all potential losses of the traded stock. If the traded stock shares decrease in value, the fund may lose all of its value if the shares of the traded stock decrease by 83.33% over the course of any calendar week. Now, that would be crazy, in my opinion. It could happen. I mean, we've seen crazier things happen, unfortunately, but that is, I mean, if you think Meta dropping by 83% or Robinhood or Tesla in a calendar week, I mean, it would be wild. There's probably a lot worse things going on than what's happening in our brokerage or our Roth IRA accounts. Now, when you look at these, like with leverage, if it was a 2x, a 50% drop would actually remove all value. So that's how it's kind of working with the 1.2%, which again, I like. So we're going to look at each of these new underlying stocks and see how they've been performing just to get an idea of what we're going to see with the new weekly pay ETFs. Amazon might be the best one of these new ETFs. I will say I'm a big fan of Amazon. I swing trade it all the time. It is one of my favorite stocks that I'm actively watching very, very consistently. Year to date, it's down 3.56%. 1 year, it's positive 13.5%. And 5 years, it's up 57%. So pretty solid track record. Not crazy as we've seen with PLTR or NVIDIA or, even some Tesla at some point. But I do like this one. I like it because I like Amazon in the long term. Even though we may be due for a little bit of a pullback, this thing did run all the way from the low of 2022, late 2022, $84, all the way up to 200 and almost 240, and then pulled back a little more. I will be buying this one. Am I going to put it in my Roth IRA? I'm not sure yet. I want to see a little bit more of the performance and hopefully see some of the stuff going on in the world calm down a little bit so our stocks can really move. But I'm really happy they added this one. It was a fantastic choice in my opinion. Then we have BRKB. This one is really interesting for the fact that Berkshire Hathaway is growth focused. I'm really surprised they threw this one in there. It is up 2.5% year to date, but it's not one of the hype stocks that I figured RoundHill would be going for. Am I upset? No, I'm not. I like BRKB. The returns speak for themselves, up 18.6% last year and 178% 5-year. Phenomenal return. Really solid, and we can see, I mean, it just keeps tracking up. My only fear with this one is Warren Buffett, I believe, is retiring at the end of this year, and if not, then soon. You never know what can happen with the business. We saw it happen with Apple at the loss of Steve Jobs, and I really hope that BRKB can continue this trend because the growth is just nearly unmatched. It's just up there with all the very solid performing growth stocks and ETFs. So good wishes for BRKB. I don't know what the distributions are going to be like, but I am hopeful. I think it was cool to add this one. It's different than a lot of the others, and maybe they're reaching for a more conservative audience when it comes to these more, I would say, old-fashioned style stocks and ETFs where you have a little bit less growth, although it's been aggressive, so I shouldn't even say less growth, but considered to be a safer pick than MSTR, than NVIDIA, than what we've been looking at in, the last couple of months. I had no idea that Robinhood was doing this well. Up 121.5% year to date. On the 1 year, up 272.5%. 5 year, up 134. So it launched, I think it IPO'd $35, ran all the way up to $55, and then trailed all the way to $7.20 at the low. If you had purchased at this time, you would be up over 1,000%. Wow. I did not. I have a gripe with Robinhood ever since the GME and AMC stuff. So I did not buy in, but maybe I should have because these returns have been amazing. And look at this trend that it is on right now. Again, I expected something like this, very hype, very volatile. People are interested. There's a lot of eyes on Robinhood stock. So I can't really complain. It's not my personal favorite, but it is one that I think could get crazy returns at a higher level of risk just because of the underlying. Just a crazy shout out to you guys, ETF Guys. My new podcast with Marcos Mia is already at over 1,000 subscribers. The first two videos are doing phenomenally well, 13,000 views. You guys have been rocking it, and I'm so, so grateful. If you want to check in, this last episode's about my investing journey, my holdings, including MSTY and QQQI, a few others, the weekly payers, all that. There's a lot of good stuff in there. I talk about RoundHill as a company, and so check it out. Let me know if you're interested in the comments. Give us some more ideas for what you guys would want to see on the podcast, and let's get back into it. Meta is an interesting one. I think there's a big market for those that love Meta. Year to date, it's up 21%, so it's performing really well. 1 year, 38.5%, and 5 years, 227.5%. So very solid. This run was insane. $90 all the way up to $736, a 711% return. Not as good as Robinhood, but still very, very impressive. I think Meta will do well. I'm not the biggest fan of the stock. It has been performing well. I'm not going to lie. I think it's a really cool option to add to this portfolio of the leveraged players. And I do like the idea of getting passive income from just holding the stock. So curious how it performs in the next couple of years. Everything going on in the world is throwing things for a loop right now, but we did see a bit of a pullback, and it already ran again from $500 back up to over $700. So if it was already a weekly payer, the dividends would have been phenomenal for METW, which is the RoundHill ticker, but only time will tell. Let me know what you think in the comments, and let's check out this free giveaway I've got going for you guys. I created a weekly dividend cheat sheet for you guys. Now I have to update it because, of course, once I finished it and sent it out, they added 5 new weekly payers, but that will be an ongoing battle. I will continue to update this. It is free. 100% free as a thank you for you guys. And the main things that I really like about it, we have the yield trailing 12 months showcasing how things are performing. But again, we have the payday. So what you're going to see is you'll be able to track what is paying out on what day in your portfolio and which ones are really performing for the longest time, because some of these are very new. They've paid out 1 to 5 distributions. Some paid out a lot of weeklies, but they converted from monthly. All that data is on here for free for you guys on my website as well, spencerinvests.com. So check it out. Let me know what you think. I'm always open to feedback, and let's check out our final new weekly paying dividend ETF. Netflix would have performed phenomenally as a weekly payer. It's up 43.5% year to date. 1 year, we're up 90%, and 5 year, we're up almost 200%, 188. This thing dropped like crazy. All of them dropped at similar times around the 2022 to 2023 mark. Netflix had a lot going on. They've shifted their strategies since then, and again, it is working out for them for sure. You would be up 606%. Very solid. Max, I mean, this thing was insane. They used to send DVDs in the mail. Please tell me my audience knows that. You guys, we're old enough to know that, right? Maybe some of you aren't, but that's how it used to be. You'd get them in the mail, and then you'd send them back. Very interesting, but I'm happy with Netflix. I didn't buy into this one because there were so many competitors at the time, and Netflix did prove me wrong. It has performed well despite Disney Plus, despite Amazon Prime, despite Hulu, despite so many of these other things. And one of the main reasons I think that is because they have a lot of original series that people are interested in and they're hooked. So I am definitely a fan of Netflix stock now. And I do think as a weekly payer, it could do well. We just want to see the market continue in the trend that it has. And we need Netflix to keep coming out with really good movie and TV show ideas to keep everyone engaged and paying those monthly fees. Because I think the lowest tier membership now is $7 a month, and that's still with ads. So a lot of people still love Netflix. It's kind of the OG of, video streaming. And I definitely am a fan. I do have an account for the time being until Natalia cancels it because she wants to save that money, which I get. But I hope you guys found this video informative, educational. Let me know what you think, again, down in the comments. I appreciate your support. We surpassed 17,000 subscribers, which blows my mind. And I will say, I have some big things in the works. And I hope you guys are as hyped up about them as I am when they do come out, because it's going to be wild. Absolutely wild. Some of the stuff that I am working on, and the podcast with Marcos has been amazing. He's a phenomenal ETF investor. So again, I hope you enjoyed. If you found this video useful, check out these that are popping up on your screen right now, including the weekly payers that we've seen so far this week and the crazy performance we've been getting from both RoundHill and YieldMax. Thank you guys so much. I hope to see you in the next video.